Ladies and gentlemen, good day and welcome to Trustline Advisors LLP Investor Call for AIF Fund. As a reminder, all participant lines will be in the listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Arunagiri, Founder, CEO and Chief Investment Officer. Thank you, and over to you, sir.
Thank you. Good afternoon, everybody. Welcome to our investor call for the AIF Fund. Thanks for the participation, and we really appreciate for taking time off on a weekend to attend this call. So in terms of structure, it's going to be the usual one like how we've done earlier. So initial opening commentary in terms of the general market outlook as well as the portfolio highlights, which we will pick it up from our covering note or the newsletter. And then we will leave the floor open for Q&A. So that's the plan. Overall, the opening commentary should not take more than 15-20 minutes. And probably rest of the time we'll give it for Q&A. And we would like to wrap it up, the whole session under 40-45 minutes. So that's the plan. So in terms of markets, what I would like to do is, basically go and revisit what we said in the last call. We did our last call in October 2022 for AIF and take it from there. So if you go back and look at, what we discussed in the last call, we covered broadly three views. So the first one on the markets, we said, the liquidity cycle, probably India would decouple on the profit cycle, but it will find it difficult to decouple on the liquidity cycle. So which meant the markets will struggle to gain momentum because their FI sentiment will be low. And this momentum on, for the markets will probably come when the visibility returns for the liquidity. That we said the liquidity for, visibility for liquidity would probably happen as and when the dust settles on the Fed tightening cycle. This is what we said on the market. And then specifically India macro, we said, India macro was on a sweet spot for the global investors. And precisely because of, resilient rupee and stable forex reserves and superior debt profile and attractive growth cycle. So this is will make India very attractive for global investors, and though it will be attractive in the medium to long term, in the short term, I think liquidity linkages would still drive the short term performance for the market. That's what we said. And then finally, in terms of FI return, there will be an aggressive return from FIs on the reallocation in terms of money moving from China. We said, how. We will again discuss a little more detail on that. So these are three broad topics we covered in the last call. Now let's look at, how, 6 months have passed now. We are in now April 2023. So where do we score in all these, in terms of where do we stand in each of these, and look at, anything has materially changed or things are the same way like what we discussed in October. So let's first look at liquidity. I think markets, as expected, have struggled to gain momentum. In the last 6 months, it hasn't done much. It has moved up and down, but basically it hasn't moved anywhere. So it has been stuck on the same place because of liquidity issues, right? Like how we spoke in the last time. Now, so in terms of now looking ahead, how is it going to be on the same liquidity? So this is what we need to look at. And so basically on the Fed tightening cycle, has anything changed, has anything materially changed in terms of the inflation battle from Fed? But nothing material, though Fed has raised rates, consequent in every policy meeting, the battle is still not won. And inflation, if you look at the core inflation in the US, it's still sticky, and the job numbers are tight, and growth is still not slowing down as much as what Fed would like to see. So given this, I think Fed is, basically the policy is they would like to continue to raise rates. Though the quantum of rates in the last hike has come down from, expected 50 bips to 25 bips, that's more on worries on the financial stress than on any comfort on inflation. So even if you assume that Fed is going to take a pause at this stage, still, given the target rate of 2% for inflation, it's going to be a long time before Fed can, Fed can do anything on the interest rate in terms of cuts, which means the rates are going to be elevated for quite some time. So given kind of visibility on the Fed rate cycle, it is unlikely that we will see any momentum on the liquidity anytime soon. Which basically means that market will continue to drift like how it has been in the last 1 year with no major movements until visibility comes on the Fed tightening cycle. This is the most likely scenario. This is as far as the liquidity is concerned. Now let's come back to the India macro, story, which we said, it is on a sweet spot because of those factors. Resilient rupee, stable forex reserves, and superior external debt profile, and attractive growth cycle. Now, if at all, if you revisit again and see 6 months down the line, has anything changed? It has only become stronger thanks to one more factor which is adding strength to India macro, which is on the external current account. So let me explain how it is. We have discussed this in many forums. I have also extensively written about it in our recent biz notes. Basically, what we are saying, for the first time ever, the trade account, if you look at the February trade numbers, both services and goods, we are almost, for the first time ever, we are almost close to break even on the trades when you include services, exports and imports on services. So if you look at only the trade deficit for the goods, it's about $17 billion, which was the number for February. And the service surplus was close to about $14 billion. Which means effectively your trade account, including services, we were almost breaking even at near $3 billion in February. March numbers also something similar. So what has made, this has made our current account much stronger. In fact, if you look at all the forecasts from many of the brokerages as well as from many economists, earlier the current account deficit which they were forecasting for about 2.4% for FY24. Now all of them are revising, successfully downwards to about 1.6, 1.4, 1.5%, which is a huge comfort. If you go back and look at earlier down cycle, we used to have current account shooting up to about 3.5% of GDP, which used to put so much pressure on our currencies, and currency used to go into a spin, which in turn is to impact the equity markets. Now we have, even in the down cycle, we are talking about a current account, which is, deficit, which is now closer to about 1.5, 1.6%. That's a huge change. This is added to the already stable and strong India macro. Now, why it has happened? Of course, I think this is primarily because our service trade has really, it has grown very well in FY23. The outlook is very strong for even FY24. If you look at our service surplus, pre-pandemic we used to have about $6 billion service surplus, which has moved now close to about $12 billion. And in FY24 per month I'm talking about. In FY24, this monthly service surplus probably will move about $14-15 billion. So that's a huge comfort. It is happening primarily because the strength in IT. More than the mainstream IT services, I think there's a hidden space where there's a huge momentum one is witnessing, which is into global captive centers, global capability centers. Globally, I think now people are much more open to outsource from India in terms of R&D, accounting, professional engineering services. So all that is ramping up, multifold in India. And the number of GCCs set up in the last few years have almost, gone up by 50%. And it's likely to gather momentum. So this is adding another factor to our India macro. Even if you look at this is on the service trade front, even on the goods, even if you look at the goods number, merchandise goods number for the last year and the coming year, the electronics exports has seen a very, very significant jump last year, and which is likely to see further traction. Just as an example of, as all of us would have probably read about it, Apple probably exports close to 5 to 6% of their global production of iPhones, which is now translating about $5-6 billion. I think the latest number is about close to $6 or $7 billion. Now, this is expected to move to close to about 25% in 2 years of their global iPhone production, which is, we are talking about the $6-7 billion of exports for iPhones to move up, to scale up to about $25 billion in few years. So given all these, I think the macro story for India is looking very strong. So that is one thing which we covered. I think it has only got stronger from what we discussed in the last call. The third point which we discussed was about FI's aggressive return, because of reallocation from China. Of course, we said it is not going to happen overnight, it is going to happen over time. And that also you will start seeing some early signs of such a shift only after the momentum returns to the market, after the visibility on the Fed cycle happens. So far that has not happened, so you wouldn't have seen the FI's return so far. But as and when they return, there is going to be a huge momentum in terms of FI inflows into India because of this reallocation. Last time we said that, if there is, currently if you look at, the kind of, if there is $1 which is coming from FIs into India, there is $5 to $5.5 which is going into China. Right? There will be some marginal shift in these ratios. Maybe this 1 will move to 1.5 in few years, and that 5 and 5.5 of China would probably stagnate there. So this is the shift we were talking about, and we still believe that this would happen, but over time, and this is early signs you will start seeing whenever FIs start, the inflows, the FI sentiment comes back in the markets, which is likely once we have some visibility in terms of what Fed is likely to, when Fed is likely to finish off with their with its tightening cycle. So these are the 3 points we covered, and I would like to add to this now in this call one more. Obviously, the favorable points for India is about the EM and emerging markets and the US, kind of how they. What is the pattern one is seeing, what is likely to happen for the coming years, right? This again, I think we had written about this earlier, but I thought this would be the right forum to again highlight. So if you look at the past decades, and if you look at the relationship between the US markets and the emerging markets, you will find a very, very interesting pattern between these two. One is whenever US has done very well, emerging markets have been very sluggish in terms of decades. And whenever US has not done well, of course the emerging markets have done. This is played out for many, many decades. In the last decade, US has done very well. And now, in the coming decade, how it's going to be the outlook for EMs versus US. This is one interesting analysis done by one Mr. Christopher Bloomstrand in his annual letter. So in that study, what he has done is, he has looked at the last decade and found that US has done close to about, if you look at the S&P as a benchmark, S&P index has done close to about 16.6% annualized return over the last decade. This is as on probably December or October 2022. So 10 years it has done about 16.6% return, including the dividends of 2.4%. Now, at the same time, what emerging markets have done is close to about 3% annualized return. This is excluding dividends. It's a very, very pathetic and sluggish return for all the EMs in the last decade. Now, one step further, what he has done is in terms of returns of 16.6, he has tried to break it up in terms of how much has come from margin expansion, how much has come from sales growth, how much has come from multiple expansion. So that study found that 3.8% came from sales growth for all, S&P 16.6% return when you break it up. 3.8% came from sales growth, and about 4% came from margin expansion, and close to about 6.4% came from multiple expansion. And the balance 2.4 came from dividend yield. This is the breakup of that return. Now looking ahead the next decade, even if you assume that the companies are going to grow at the same sales growth of 3 to 3.5%, getting this margin expansion of 4% and multiple expansion of 6.5%, 6.4% of multiple expansion is very, very unlikely. So, in all, even if you assume very rosy picture for US growth of 3.5% for sales top line expansion, and add to that the dividend of about another 2%, at best you are looking at a return for US of about 5% annualized. So if US is going to do that 5% in the next decade, it automatically going by the historical pattern that EMs are likely to do much, much better in the coming decade. Assuming that this view is going to play out, in EMs, again if you break it up and look at the countries, each of them have been, have some country specific or geopolitical issues within EM. If you look at China, China is going to struggle with growth as well as with geopolitical, diversification of supply chain for China. Taiwan has got a similar issue in terms of geopolitics. And you have Brazil, where the growth is the challenge. People are saying, in Brazil, show me the growth or show me the story. And Brazil, you have an issue. So India seems to again stand out in that emerging market basket, which means if there's going to be further allocation in EMs because of this changing pattern of growth outlook between US and EMs, India is likely to attract much more attention and allocation even because of this factor. So one is because of China's reallocation. The other one is within the EM basket, I think India looks much stronger thanks to other countries having country-specific issues. So this is, overall what you look at is, from these discussions, what we find is two very contrasting situations. Right, on one side you have a global macro uncertainty and slowing growth in developed countries. On the other side you have very, very strong macro which is getting further stronger as the day goes by for India. How does one reconcile these two to navigate the financial markets? That's a very interesting debate, right? Now the key point one needs to remember is, even though the medium to long term prospects are looking very strong for India, in terms of markets, it is a very unique beast. It's going to be much more driven by sentiment and flows in the short term than your medium-term prospects and outlook. So given the current liquidity cycle and given the current visibility in terms of interest rate outlook and inflation outlook, it's very, very unlikely in the short term you will see any of those reflections of this brighter side of India in the markets, which means market will continue to struggle. Markets will continue to, struggle in terms of gaining momentum in the short term, but one needs to keep this longer term view when it comes to investment. So in this scenario, what we see is market will continue to gravitate towards value, which the kind of shift which we started happening from October 2021, when, the momentum for the market started slowing down, which means market is will continue to gravitate towards value and reward stock-specific actions, which is what we are seeing in the market. Growth and expensive stocks that got punished post-October 21 will continue to drift directionless or will become less expensive. Market will reward stock-specific action as it has been doing since October 21. Of course, there will be pause in those whenever there is dislocation from either internal or external events like your Adani saga or SVB, Silicon Valley Bank crisis. But overall, directionally, since the market will reward value, it will continue to witness stock-specific actions for a foreseeable period. Big momentum in the market is unlikely, which is critical for market shifting towards growth. So that's a view we have currently on the overall market trend. So given this kind of visibility, I think what we have been doing, of course in AIF, we have almost finished building the portfolio. Now we are waiting for the portfolio to, unlock value and then get those realized gains. But the overall aspect, I think one has to be stock specific in this market and it has to be, the portfolio needs to be structured value-oriented, and primarily, look at sectors which are domestic-driven. So that's the kind of, view we have on the overall trend for the market. So let me conclude my opening commentary. Thanks a lot for all of you for participating on a weekend. We really appreciate that and look forward to the next investor call in October 23. That is 6 months later. Thanks once again. Thanks a lot.
Thank you. On behalf of Trustline Advisors LLP, that concludes this conference. Thank you for joining us. You may now disconnect your lines.